Value investing isn't about predicting tomorrow's stock price. It's about finding companies that will keep performing year after year. You see, price moves with emotions, but value moves with earnings, efficiency, and trust. The core idea, buy when others are fearful, sell when others are greedy, Warren Buffett's timeless mantra. But let's decode this Indian style. When everyone's running after trending stocks, you quietly research solid businesses like FMCG, banking, or energy. Companies that might be boring but consistently profitable. Because markets may reward excitement in the short run, but in the long run, they reward performance. In today's episode, we will first list down what we will learn and the modern tech we will use for having a smart, easy to use approach which you can easily adopt. Then we will go into detailed presentation mode to understand each one in details and finally see real applications by using the websites and AI technology available to us. So how do we measure value? We will learn some key fundamental indicators. You can check EPS, PE, ROE, shareholding patterns, and even AI-powered stock scores on platforms like TickerTape, Skinner.in, Trendline, Money Control, or even ChatGPT-style stock screeners. So you don't need to be an MBA or an analyst. You just need to be curious, disciplined, and logical. In today's digital India, the power of research is literally in your pocket or on your phone. So instead of asking, कौन सा stock चलेगा, ask, कौन सा business grow करेगा. That mindset shift is what creates wealth. Value investing isn't about chasing luck. It's about understanding logic. It's not about timing the market. It's about trusting time in the market. Because with the right mindset and modern tools, a common investor can make uncommon returns. याद रखिए, smart money is not fast money. It's patient money. And patience, my friend, compounds beautifully. Okay, so welcome to the very exciting world of value investing. Today we will understand how to decode value, how to identify shares where you are paying a price which is less than the value, and then how to use modern technology like AI, scanners, etc. to identify shares for investment. The idea is investing in stocks which are undervalued compared to the intrinsic worth that they bring to the table, which is basically identifying businesses which which have been doing really well, which will do really well in the future. However, the price that you need to pay to buy the shares of these companies are not equivalent to the value that they bring. So we will buy low, hold long, and then try to sell high. And our selection of shares, our analysis will be driven by fundamentals and not market hype. We will not get impacted by the daily movement of price. We will not impacted by technical analysis, maybe not even day-to-day global events and news. However, we will track the fundamental parameters of these companies on a regular basis, and that will be the key reason why we should enter into a share or why should we exit. There is a famous quote by Warren Buffett. He said, price is what you pay and value is what you get. So price and value are not the two same things, right? Price is the money that you pay to, let's say, buy a share, and the value that you get is basically the access to the business of the company, access to the profit of the company. And now, if the price that you're paying is less than the value that you're getting, that's a good deal. You always want to get a good discount at a shop, right? You want to buy a good thing at a lesser price. That is always what we want to do. So, if that can be done through fundamental analysis, we can definitely identify shares and sit on them for long-term value delivery. Okay, so what are the key focus areas? So we will look at companies with strong business fundamentals, companies who have been profitable consistently year on year. Then the valuation of these companies are quite reasonable or they are undervalued at this point of time, and we have to identify that before everybody identifies, right? And then the future holds a very strong long-term sustainable growth story for that particular company. This company can be benefited by maybe political changes, maybe technological changes, all these advancements which are happening in socio-cultural development. It can be anything which has the promise to create a better future for the company. We can take some examples. Let's say the Indian middle class is rising. The money in their hand which they can spend is also increasing day by day. That essentially means that consumer good companies, right, consumer durables, even some of the automobile companies, etc., can grow fast in the long term future. uh, then which companies can get benefited by AI, right? Which companies are leveraging AI very well? Then the Indian government today is driving a make in India policy. Which are the companies who can get benefited by that? So if we can identify certain trends happening all around us, it is possible to then analyze and take the right decisions. Of course, today we will learn how to utilize scanners and technology to do the same thing that I'm talking about, which will help you to identify uh, companies which are doing good and which probably will also continue to do good. Now, what we will learn are some of the key fundamental indicators. We will very quickly go through their definitions and try to understand the top maybe 8, 10 indicators. Why it is important? Because it is not only to understand their meanings. We will use the same indicators now to put in a scanner, and that scanner will essentially give you the shares which satisfy all the important conditions based on these fundamental indicators. The first one in the list is EPS, or earning per share. The formula is simple. What is the total net profit of the company? If you divide that with the number of shares which are listed on the stock market, that is basically EPS. It basically shows what is the company's profitability at per share level. For example, of course, any one person or one institution will not be buying all the shares of one company, right? For example, let's say you buy 100 shares of Tata Motors. Now, you do not have access to the whole profit earning of Tata Motors, but you are still a minority shareholder of the company. And because you have 100 shares, you have access to 100 EPS, right? So if the earning per share is, let's say, X rupees, then you have access to 100x uh, of earnings of the company. So that is basically EPS. What is more important is EPS growth rate, right? And company should be delivering growth year on year, and hence because the number of shares listed in the market is not really going up unless the company brings in more shares. What will happen if the earning is going up? EPS being a ratio of net profit and the number of shares, EPS will also grow. And a growing EPS is a very healthy sign for a company. And we need to understand what is the annual growth percentage of EPS, and we need to track that. Okay, so if a company is having high growth and also stable margins, margins is what? Gross margin and net margin and those sort of things. If you understand P&L, if you have worked in a commercial setup, you will probably know all of those things. Even if you don't do, it's fine, because anyways, we are going to use a screener to do all the work for us, and you don't necessarily need to be a master in finance to, really do this analysis. And that is the promise that I'm making to all of you. Next important ratio that we will learn about is price to earning ratio. The formula is basically the market price, which is the last traded price of that instrument in the market, divided by EPS, which essentially tells you how much an investor, maybe you or me, are paying to have access to 1 rupee earning of the company. Now, if the PE is low, and it can probably mean that the company is undervalued. If the PE is high, it can probably mean that the company is overvalued. Not necessarily, because PE on its own does not tell you the whole story. So what you need to do is the next thing that we are going to learn, which is you will have to compare the PE of the company to the industry median. So let's say Tata Motors belongs to the automobile industry. So what we need to do is to see how is the PE of Tata Motors, or let's say Hero MotoCorp, compared to the PE of the auto industry. So if the PE of Tata Motors is much lesser than the median PE of the industry, that means that Tata Motors is undervalued and there is scope for growth. However, if the reverse happens and you see that the PE of a particular company is much higher than the median PE of that industry, it means the company is overvalued and there is a potential risk that the share price might come down in the near to midterm future. And specifically, companies with high PE, high valuation, companies who are overvalued, generally do suffer the most drastic crashes when there are bad news or there is something happening out there in the industry which is not favorable for that particular company. Okay. Next important um, ratio that we will learn is return on equity. And the formula is what is the net profit of the company per shareholders equity, which is basically net profit divided by shareholders equity. What is equity? Equity is basically the money that the shareholders have paid in totality to buy the shares of the company, to become shareholders of the company, right? So the company has got money from the shareholders and the company is utilizing that money to earn profit. So this particular ratio is basically showing how well, how efficiently the company is using shareholder capital, and a good benchmark is generally more than 15% for strong businesses. The next important ratio is ROCE, which is return on capital employed, and the formula is uh, EBITDA, earning before interest, tax, depreciation, amortization divided by the sum of equity plus debt. Now, the company has access to money in two different ways, right? Majorly two different ways. One is equity, when they're listing their shares in the share market and shareholders are buying that and the company is getting money out of it. This generally happens in the primary market before it is listed for trading. The second way the company can have access to money is debt, which basically means the company can borrow money from different institutions and then of course they will have to pay interest on that. Now, this particular ratio tells us how well the company is utilizing its capital, which is the sum total of debt and equity. Um, and this is a very very good parameter of how efficient the operation and the strategy of the company is. Okay, so you don't need to be a PhD in all of those things, but just understand the key concepts, and we will utilize these things in the scanner and in AI driven searches when we go ahead. The next one, and this one is one of my favorites, is Piotrowski score. Piotrowski score basically uh, gives a score to a company based on 9 different financial parameters, and it's a composite score. So if the Piotrowski score of a company is, let's say, 0 to 3 or 0 to 4, that basically means that the company's financials are not very strong and you should not be interested in long term shareholding in these companies. However, if the Piotrowski score is more than 7, let's say 8 or 9, then um, the summary is that the company is financially very strong and you should consider that company for long term shareholding. So Piotrowski score is also something that we will put in the scanner to figure out which companies have high Piotrowski score. Another one, which is also I think is a very very important consideration, is institutional shareholding pattern. How the DIIs, the domestic institutional investors, and FIIs, the foreign institutional investors, are ramping up or decreasing their shareholding in a particular company. That talks about institutional confidence. Now, retail traders do not have access to a lot of technology or research tools. However, the FIIs and DIIs have big teams. They hire the best brains in the country. They utilize the most advanced technology which is possible today. So, if after their research they are confident in a particular company, we should follow their footsteps. We should not do something different. So, if FIIs are increasing their shareholding in a particular company, you can probably follow it blindly, but you follow that pattern over a few quarters to make sure that they are consistently improving their shareholding in that particular company. Another thing which I also want to mention is, um, please have a look at the shareholding pattern of the promoter. The promoter is the, probably the owner of the company who has the major shareholding in that particular company. And the person or the entity who has complete knowledge about what's happening in the business, how it is going to perform over the next few years, etc., are the promoters. So if you see that promoters are decreasing their shareholding pattern, that's a big red sign. So you should not enter there. But if you see that promoter shareholding pattern is stable, or even promoters are buying back shares from the market, that is a strong sign that the company is probably going to do well. So that is also an important sign that you should look out for. Now, finally, we have talked about is all the ratios, which basically tells you the status quo, how the company is standing today, or how the company has performed in the past. What those ratios don't tell you essentially is how the company will perform in the future. And if you're buying the shares today, you basically want to be sure that how the company's performance will evolve over the next several years. So, how to estimate the future growth potential of a company? So, let's say the first thing that you can look at is how the company has been doing in the last 4 5 years. That definitely gives you a trend line to look at. Next important thing is industry outlook. What is the growth potential of the sector in which the company belongs to? And I already gave some examples beforehand, that which companies are using AI better, or which companies are, uh, you know, which companies can utilize the rising spending power of the middle class better, which companies will benefit from the government policies, all those sort of things you can look at. Another very important is the company guidance. What is the narrative that management is telling the shareholders during their quarterly earning meetings? Is the management confident? Is the management projecting their growth at a significant level over the next year or over the next several years? Is the management saying that the company will outperform the sector? All these sort of things we must look at, because these also build investor sentiments. And as you understand, management is very well versed with what the company is doing today. So there is no better person to comment on the future prospect of a company than its own management. The next important thing that you want to understand is competitive advantage. Is the company better than the other players who are operating in the market? And we will try to understand what are the different types of competitive advantage that we can consider. Number one, of course, will be, is it does the company has good brand equity, or it markets brand with very high equity with the consumers or the users? Does the company has cost efficiency? What is cost efficiency? Can the company produce their goods or services at a cost which is significantly better than the rest of the universe or the rest of the sector? And that basically enables the company to have higher gross margin on their products and services. And this is also known as, cost leadership. And does the company have technological advantage? Is it using the modern tech, the AI, um, you know, and any technology which is relevant to its business to deliver sustainable growth? Finally, very, very important point is reinvestment rate. Is the company reinvesting in itself? Which basically means, is it reinvesting the profits to create more capabilities, create more skill sets, hire better people? That basically ensures that the company has good plans, solid plans for future expansion. So, just to summarize, if you combine fundamental strength and growth visibility and reasonable valuation, that is your starting point for identifying and then procuring the shares of a company for long term compounding returns. Okay, so before we go into the practical applications, let's understand what are the different tools that we will utilize, and also how we will consider entry into a particular share, and what we should do for maintaining the trades. First of all, we will use screener.in, an excellent website where you can simply put in all the criteria that you want a company to be evaluated on, and it will simply give you the list of all these companies who are satisfying those criteria. For example, you want a company whose peer thrust score is more than 7, and it is delivering an ROE and ROCE more than 15% consistently, and the shareholding pattern of FIIs are increasing. If you just put this criteria on screener.in, it will give you the name of the companies. And then, of course, you will have to put them on chart at least once, because you do not want to buy something which has already, has been through some bull run in the recent past. You don't want to buy that immediately. You want that to get corrected a bit. So don't buy blindly after identifying those shares. It is important that you plot them on the chart, and maybe, while technical analysis is not so important, but at least see that you are not buying at a very high point. Okay. Second is we will also utilize AI, and one of the new tools which has come into the Indian market is Perplexity AI. And we can we will see how, when you give some commands, how this particular platform is giving you options. And I will also demonstrate moneycontrol.com. This is, of course, not a uh, you know advertisement for that website, but it's a very good website and I use it very, very regularly, and it gives a lot of nuances on analyst rating, shareholding pattern, what are the different news, what are the technical indicators, etc. So, we will have a look at that as well. So the idea is, once you have identified something in screener.in, you can go to moneycontrol.com and do further analysis on that. It is possible in screener also, but just see that what is more comfortable for you. Okay, so we said that value investing is long term holding, so we will not be very worried by technical indicators. However, the lesser format of value investing is positional trading. But if you're doing positional trading, which basically means you are holding that share for, let's say, a few weeks to a few months, then you must also bring in technical indicators on a longer term chart patterns, weekly and monthly charts. I said that technical analysis might not be very relevant for long term value investing, but please ensure that you are checking the chart and not buying at a very high point. The second thing is, um, you should also monitor your value investment on a monthly chart, let's say at least once a quarter, maybe once a month. This is just to stay satisfied that the stock is still on a positive bias. If it is in a consolidation phase, that's absolutely fine. That there is no problem with that, because you don't want the gains tomorrow. It can give you gains later on as well. But in case something happened and you totally missed that news, or you are not aware about that update, at least the chart will tell you that something is wrong. So it's a good practice to sometimes look at the chart of all the shares that you are invested in, even for long term purpose. Very, very important, build your position in phases. Let's say you want to invest 5 lakh in a particular company to buy shares. Please do not invest or buy shares worth of 5 lakhs on the very first day. At least divide it into 5 different parts and then buy in phases, maybe in 5 different quarters if that is needed. So that essentially means that you are not buying at a top. If the price corrects, then you have more opportunities to accumulate. Secondly, you are not putting all your eggs in one basket. You are spreading it out over a horizon that gives you more flexibility to track the result and the vision of the company over several quarters, maybe a couple of years, before you go fully invested in there. So it's a good practice if you're building your positions in phases. Trade maintenance, positional trading, you should follow weekly charts and indicators. We have talked about this in details in the past. Uh, Value investing, what you should always do, regularly do, is to follow quarterly results. You should follow the announcements done by the companies, how the DII and FII positions are moving in terms of shareholding pattern. and how the fundamental indicators are evolving. Are they following your expectations the way you thought they would, or there are deviations? Those sort of things you should always look at. And of course, the monthly chart, as I mentioned. Okay, now, so we will move to the next part where we will use real scanners, real technology to identify shares. See you there.
Now we will use screener.in to scan companies for value investing based on different criteria that we can put in. It is free to use. So this is screener.in. You can go here and type create new scheme. Click on that. And there, this is a search query which is opened. And you will have to plot your conditions here. And you can see an example. So we can follow the same example, similar example rather. So what we will start with is we want a company whose ROE and ROCE is more than 15%. We want to look at a company whose PE, price to earning ratio, is less than the industry median. So let's do this. So first of all, we will plot price, and as soon as you start plotting here, you will see the options coming up. So we will say price to earning more than price to earning is more than, no, sorry, we have to go for less than, right? We have to go for less than industry P, and we want ROE, return on equity, to be more than at least 15%, and we want ROCE, return on capital employed, to be more than 15%, and we want, let's say, we also want to put a condition on PF risk score should be more than 6, which is basically 7, 8, 9, and we want to also understand FII shareholding pattern. FII holding is at least more than 10%. FII holding is at least more than 10% of the company's total share availability, and FII holding. FIIs are also increasing the shareholding pattern. Let's say at least by 0.25%. Okay. Cool. I think this is a very, very strong query which takes care of almost everything that we learned about. Let's see what shares come up when we run this query. So now you see, as soon as we ran that query, all the shares which satisfy all those important parameters have now been auto-selected here. And then what you have to do next is to go and plot the shares on a chart and see where they are. And if in terms of value investing, of course, you might not be very interested in technical analysis, but at least, plot them on the chart before you buy, so that, you do not buy at a very, at a point where the share price in the recent time has given a lot of momentum, then it can fizzle out and your capital can get blocked, or you do not have a proper starting point, to be very honest. For example, Hero MotoCorp, right? You see the PE is, uh, where is the industry PE here? Industry PE is here. Uh, it is less than the industry PE, but when you go to Hero MotoCorp chart, you will see that it has given very strong bullish run in the last several months. So you don't want to enter Hero MotoCorp right now. So this, I mean, looking at the chart will always help. Uh, but anyways, let's see a company, National Aluminium, right? Its PE is only 7.8, while the industry PE is 22. So it is only one third of the industry PE. So that's a very strong indicator. If you see ROCE 43%, that is exceptional. You see sales growth happening at 30%, profit growing at 119%. ROE, return on equity, is also growing by 32%. So exceptional fundamentals. So definitely national aluminium can be a good bet, and so on and so forth. So now you should actually go and uh, look at all the important other important factors for this particular share. If you click on that, you will also see the chart patterns, the pros and cons, which is coming out, and they are not listing any cons for uh, national aluminium, and it is also showing the peers, right? So the industry where it belongs to, which is basically metals and minings. In that, what are the other shares which are also listed and how they are doing? So all these analysis you can do on screener. You can look at quarterly results. You can look at the profit and loss statement, balance sheet, all of those things, cash flows, etc., etc. But I think that you know, for a common retail trader, if you have selected a share based on the criteria that you showed in the previous screen, it should be sufficient enough. But definitely, you need to follow their earnings after you have entered and follow their management commentary after you have entered to ensure that there is nothing bad happening in the performance of the company or there is nothing concerning in the future growth story of the company so that you can stay invested with confidence. Okay. Now we will also use AI to see can the same task be done by AI as well. And for that purpose, we have opened Perplexity AI. So let me give me the shares where FII shareholding is increasing and the company is of pure trustee, so which is more than 7. Okay. So it gave you all the name of the companies which satisfies this criteria. And of course, you can, I just gave a demonstration. You can actually add much more conditions, complex conditions. Okay, finally, now we will have a look at moneycontrol.com and see that what sort of data and charting support they provide. Please note, this is not promotion on behalf of Money Control because I use it and I am a Money Control Pro user. So I'm just demonstrating that what can be done here. So let's say we identified National Aluminium, right, as one of the key stocks where we can consider investing. National Aluminium. Let's see. Okay. You see here it is the share price, etc. So they have listed what are the different strengths of this company. You can click here and read the strengths. There are no weaknesses. There are opportunities which they are listing. And then trades on a technical point of view, we are saying that there is a footing star which formed in the last daily candle. But anyways, we are considering this for long-term investment, so we are not very worried about short-term technical things. Now let's see what else. Advanced chart. Okay. Now what is important is this one, which is MC Insights, Money Control Insights, and that is available only for the pro members. Here you see they have listed down some of the key factors. So it is saying that it is under bullish momentum, it is outperforming the overall market Nifty. Then the Petrus score of this particular company is very strong, 8, which indicates strong financials. If you look at the 3-year CAGR growth, revenue has been growing in double digit, net profit in double digit, operating profit as well as in double digit. Then some of the other factors, the PE ratio is below median, which is a very good sign. It's undervalued. Uh, Then your quarter net profit growth is above median, growing better than the other companies in the industry. Revenue growth is better than the median. Return on equity is above the median. It's doing better in terms of utilizing the equity of shareholders compared to peers. Now, what is very, very important is also shareholding pattern. And here you can see that promoter holding, which is basically the owner of the company or people who own the company, is unchanged. So they are having confidence. They're not really shelling off their shares. No change in promoter pledge, and promoter pledge stands at 0%, which basically means the company has not pledged their shares to take loans from institutions. So that's a very, very good sign. FIIs, foreign institutions, are increasing the shareholding. And in the September last quarter, we have seen that more than 1% increase in shareholding, which is a very strong sign. FIIs entering into that. BIOs have decreased their shareholding slightly, marginally, but overall, institutional investors have actually increased their shareholding pattern, which is a very strong sign, a support sign for the share. And also public, the common retail traders are reducing their shareholding pattern, which is also a good sign, which basically means that this particular share should perform very, very strongly in the uh, near-term horizon. Now, what we need to also understand is um, another company where the scenario might not be very good. Let's put in Suzlon. And Suzlon, of course, is one of the favorite shares of retail shareholders. Let's take another example, Suzlon Energy, and you can see that um, they have also listed the strengths, weaknesses. We already saw that. But because we are interested in the long-term potential of this particular share, let us go down directly to the MC Insights. Here you see, of course, technically, the share currently has a bearish momentum. It is going down. Financials are not so strong. P/S score of only 3. However, they have been doing fairly well, like really well in terms of revenue growth, etc. Now, if you look into the P ratio, it's still below median, so that makes sense. There is scope to grow, but the price to book ratio is above median, which is not so good. Quarter quarter net profit growth is above median, which is good. Revenue growth is above median, which is good. ROE percent above median, which is also good. What is very concerning is promoters decreased their holding from 11.7%. Okay, it's a very small decline. It is not very significant, but promoters decreasing their shareholding consistently is a bad sign because promoters will know all about the health of the companies, and if they are decreasing, that's a concern. FIIs are also decreasing their shareholding pattern. DIIs are also decreasing their shareholding pattern. These are very, very bad signs for companies from the midterm performance in terms of share price. Institutional investors have decreased their shareholding pattern as a result. And common public is increasing, which is also a bad sign. So for Suzlon, I think short-term trading, swing trading, or short-term gain where you stay in the trade for a few weeks to maybe 1 or 2 months is fine. But long-term holding uh, for 5 to 10 years or more is not suggested unless you see there has been improvement in the peer-trust score, you see improvement in the shareholding pattern from DIIs and FIIs, and they continue to perform in the way that they have delivered revenue and net profit growth. So there are certain things to be watched out for. So do not consider this right now for long-term value investing. Short-term trading can definitely be considered for Suzlon Energy. That's all from my side today. Thank you very much. See you in the next episode.